Hi, I'm Patu from freefincal, and today let's talk about how long will you be patient or how long can you tolerate negative stock market returns. This is related to a question I had asked in Facebook group Asan Ideas for Wealth. I had asked on 9th November, you're invested in equity for the very long term. How many consecutive years of zero or negative returns can you tolerate without stopping investments and or pulling out money? I gave them a lot of options like 1 year, 2 year, 3 year, 5 years, so on. Stock market will never give negative returns over 5 years, and so many options were given. And what I mean by this is, I will have the poll here as well. I don't know if I can have so many options here. Let me try. Maybe not. Let me try. So what I mean by this is, you invest and you keep investing. After 1 year, you check your annualized return. It's zero or negative. You keep investing. You wait, and then after 2 years, it's zero or negative. After 3 years, it's zero or negative. After 4 years, it's zero or negative. After 5 years, it's zero or negative. How many such bad years can you tolerate without stopping investments or pulling out money? And I'd asked for an honest response, and I did get, I believe, an honest response. So, as many as 467 people had participated. That's a fairly decent number. 154 voted for 3 years. They will wait for 3 years. After that, they will pull out money. 144 said they will wait for 2 years. 81 said they will wait for 5 years. 33 said they will wait for 4 years. And 24 said they will wait for 10 plus years. They are willing to wait for 10 plus years. 16 said they will wait only 1 year. 5 said they will wait 7 years. And 5 actually said that the stock market can give negative, 5 actually said that the stock market can never give negative returns over 5 years and so on. There are a few other votes, less than 2-3 votes here and there, but that's not really too important. So that's the general gist. So it looks like the majority of the 460 odd people who voted will start losing patience 2 to 3 years or so, roughly. And this is the right thing to do, wrong thing to do. It's very difficult. This is the biggest problem with equity investing. This is see, it has got no guarantees. Yet you need it to have a chance of beating inflation at lower investment compared to fixed income. So nobody can tell how long you should wait. This is the correct strategy. That's the correct strategy. Nobody has. I don't have any right answers, wrong answers. I have some anecdotal evidence here and there. I have done some back testing on this. I talked about how in a video on how to reduce your risk in your investment portfolio. I've talked about how you can stepwise reduce equity allocation. So let me combine both the anecdotal evidence as well as the result of that in the rest of the slides. You can I've linked the video. So this is the 5-year rolling returns of the Nifty 50 total returns index. Sadly, we have data only from 1999 or so. Before that, it would have been worse. And there are 2,103 5-year data points in that yellow line. And notice that there are many times when the returns were single digits. Note that when equity returns become single digit, if you factor in tax, it will become very close to PPF. Even if you assume PPF is 7%, it will become very close to it. And therefore, for all the risk that you undertake, the reward will be disproportionate. And that is the biggest problem in equity. Notice that it has indeed given zero, maybe even negative returns in that period. You may say it's only a small period, but believe it or not, those 5-year period, that 5-year period was my first 5 years in investing. When I started investing, for the first 5 years, I got zero returns. And also you can see that we'll come to that. Anything less than, like I said, anything less than 10% is problematic because you're not getting that necessary reward for the risk you're taking. So it is extremely volatile. Look at the span in the returns. For the next 5 years, how much will Nifty 50 index fund give? If anybody asks this question, nobody can answer anything. It's just pot luck. It can be anything. It can depend on which side of the bed you got up or which side of the bed your dog got up. So it's just pot luck. And this is the gain in my retirement portfolio. older viewers or readers may have seen this. I have not updated this for a long time. It's time for an audit in December. I will update it then. So this is just a gain or loss. Notice that after I started investing for the first 5 years, zero, nothing. Almost for the first 5 years or so, little more maybe, nothing. But during this period, I had shown in my audits, I didn't know what was happening, thankfully, but I had invested a lot of money, and therefore, when the markets picked up, it changed my life completely. It changed everything about the way I invest, the way I look at money, and so on. People ask, how can I be patient? How can I manage? My advice to them is, please don't look at your portfolios. Don't look at it. That's the only reason I got rich. I've got rich not because of some talent, mathematical ability. Because of, some people say, oh, Pattu is from IIT Madras. That's why he's an intelligent investor. I've heard people say stupid things like that. This got nothing to do with it. It's just simple mantra: ignorance is bliss. Leave it alone. I had no idea 2008 was happening, frankly speaking. I had so many other personal problems at that time. I couldn't look at my portfolio, but I knew that I had to invest. I knew it was kind of red, but I did not know how much or whatever, nothing. But it's in hindsight, I can say I was just lucky to have invested more. But you need to be patient today. Because of so much social media penetration, so much more information penetration, overload, it is simply impossible for people to ignore what is happening in the markets. But unless and until you ignore, I guarantee you, you are going to make wrong decisions. You are going to make emotional decisions. You cannot be emotional about all this. You have to be either ignorant, or when you are aware, you must be professional about it. That's the biggest problem. So, oof, that's about the data. But what is the solution? So people are always saying, you're never showing any solutions at all. You're always showing faults. You're always being negative. Why are you so negative about the market? Am I being negative about the markets? Honestly, tell me. I mean, so I'm just telling you the truth that it's risky, but you should be aware of it. That's all. So what is the solution? The first thing I would say is, if you need money in the next 2 years, 3 years, 5 years, 7 years, 10 years also, do not use equity, because you will make emotional mistakes. If you have a bad run, if the first few years are negative, then you are in big trouble. The industry will say something, all those reporters will say something. This is garbage. Trust me, either you look at the data and come to the same conclusion, or trust me, I have looked at the data. Do not use equity for less than 10 years unless you have that emotional maturity to handle problems and manage your portfolio. Otherwise, you outsource it to somebody else, to a fee-only financial advisor. Then maybe you can have some equity. But otherwise, for most people, I would say, especially for people whom that 2 or 3 years bracket, I would say definitely don't use any equity for less than 10-year goals. I mean, the probability of messing it up becomes so much higher. If you have a if you have a long-term goal like 25, 30 years goal. So, for example, when I started in 2008, that is like 11 years ago, I had like 30 years to retirement, right? I had like 32, 33 years to retirement. That was a huge goal, so I could manage it. And if the bad phase occurs very early, then you should be patient for however long, and you should also invest more. But if the bad phase occurs a little bit later, after you have seen some returns in the middle part or maybe close to the end and so on, then you should immediately, ruthlessly, professionally decrease equity. Even if the bad phase does not occur, whatever the sequence of returns, have a very stepwise reduction. For example, let's say for a 25-year goal, let's say 30-year goal, you can have first 10 years 60% equity, and then after 5 years, after that, from the 10th to 15th year, you can make it 40% down and bring it one more level down after 5 years, something like that. Some graded decrease in equity. I will link the study here. So you have to, portfolio management cannot be done by a formula. You have to play it by the ear. As and when the situation develops, you have to handle it. That's the only problem with portfolio management. Even for financial advisors, it's a problem. For a 15-year goal, it becomes a little difficult. If the early phase occurs, if the bad phase occurs early, then I would say 5 years maximum you can wait. Even that will be kind of pushing it. Beyond that, you can't wait. You have to shift out of equity or invest, at least invest more in fixed income so that you have a target corpus. You can't simply say I believe in equity and so on. It's very difficult when you have a proper goal and a proper deadline. So, 15 years, less than 15 years, it becomes very dicey. I would say you can get it wrong. Above 15 years, there's some comfort, and 5 years for let's say 12 years, 13 years, something like that. 5 years at best. Initially, first 5 years, you can somehow manage to have some conviction and invest more. But if it happens in the middle portion, then you are in deep trouble. You have to pull out, so on. So you have to. That's the problem. So my essential point here is, I don't want to ramble on and on and say the same thing again. For very long term goals, if the early phase happens, if the negative phase happens early, please be patient for however long and invest more. That's the only reason that, I can call myself financially independent today. So, but you must be patient. But provided you are investing as per the proper asset allocation and as per your goal duration. So, how long will you be patient? Please share your comments and any other thoughts. Bye bye.